Okay, let's talk about the Roth IRA 5-year rule. You've probably heard of it, and maybe you've even been a little confused by it. Well, what if I told you the reason it's so confusing is because there are actually 2 of them? Yep, and today we're going to set the record straight once and for all.
So this term gets thrown around a lot, right? The 5-year rule. It sounds like this one single, simple thing you need to remember, but it's honestly one of the most misunderstood concepts in all of retirement planning.
And here it is. This is the secret. The reason for all the confusion is that people talk about the rule, when in reality, there are 2 completely separate 5-year rules that apply to different parts of your money and have totally different goals.
And hey, if you've been confused, you are definitely not alone. This quote from Eagle Ridge Wealth Advisors just nails it. The information out there is a maze, and even the pros sometimes take a wrong turn. But don't you worry, we're about to make it crystal clear.
Okay, before we can even touch the rules, we have to get on the same page about something absolutely crucial. How the IRS sees the money coming out of your account. Because, it's not just one big pot of cash to them. There's a very specific order.
I want you to think of your Roth IRA like a glass with 3 layers. The IRS says you always have to take a sip from the top layer first. That top layer is your direct contributions. After that's all gone, you get to the middle layer, your conversions. And only then can you get to the bottom layer, which is all your growth and earnings. And this table here, this is the official breakdown. Look at that first line. Your contributions are always yours to take, anytime for any reason, completely tax and penalty free. It's your money back. But as you can see, when we get down to conversions and earnings, well, that's where some conditions start to apply. And that's where our 2 5-year rules come into play.
All right, let's dive into rule number 1. This is the one that most people think of when they hear 5-year rule, and it's all about achieving the holy grail of the Roth IRA, making sure all that wonderful growth is 100% tax-free.
We like to call this one the forever rule. Why? Because the moment you make your very first contribution to any Roth IRA, a master clock starts ticking. It runs for your entire life, it covers every Roth IRA you will ever own, and it never ever resets. You only have to satisfy it once. And here's a really cool quirk in the system. Let's say it's April 2025, and Marcus makes a contribution for the 2024 tax year. Well, guess what? His 5-year clock doesn't start in April 2025. It actually gets backdated to January 1st, 2024. It's like you get a free head start. Now, this is super important. Satisfying the 5-year rule isn't enough on its own to get your earnings tax-free. Think of it like a bank vault that needs 2 keys to open. The 5-year rule is the first key. The second key is meeting one of these other conditions. And for most of us, that second key is simply reaching age 59 and a half.
Okay, you ready for rule number 2? This is the one that often trips people up, especially folks doing Roth conversions or the popular Backdoor Roth IRA strategy. And remember, this is a totally different animal from the rule we just talked about.
We call this the resetting rule because it's basically the opposite of the forever rule. This one is all about avoiding a 10% penalty on money you converted, but only if you're under age 59 and a half. And the key thing is, every single time you do a conversion, a brand new separate 5-year clock starts for that specific chunk of money.
So you can see how this works, right? If you convert money every year, you're going to have multiple 5-year clocks running at the same time. If you try to pull out the money from your 2025 conversion in, say, 2029, you could get hit with a penalty, even though your 2024 conversion money is totally fine. It's why keeping good records is so important.
Okay, let's just put them side by side to really lock it in. The forever rule on the left is about getting your earnings out tax-free. The resetting rule on the right is about getting your converted principal out penalty-free before age 59 and a half. One clock starts once, the other resets every time. See the difference?
But what if I told you there's a way to make some of this complexity just disappear? There's a magic number in the retirement world that acts like a master key, changing the entire game.
And yup, you probably guessed it, that number is 59 and a half. This is the age where the IRS suddenly starts treating you like a grown-up with your retirement money.
So what really happens at 59 and a half? Well, that pesky 10% early withdrawal penalty pretty much vanishes. It just goes away. And that has a huge impact on one of our 2 5-year rules.
This is a fantastic question that someone actually posted on mine. They're 63, they've been doing conversions, and they want to know if they still need to worry about that 5-year waiting period. Let's break it down for them.
The answer is, for the converted money, nope, you don't have to wait, because our Reddit user is over 59 and a half. The whole point of the resetting rule, avoiding the 10% penalty, is totally irrelevant. The penalty doesn't exist for him anymore. But
And this is a huge but. That first forever rule for earnings still absolutely matters. To get his growth out tax-free, he still needs to have started that master clock at least 5 years ago.
Okay, we have covered a ton of ground, I know. So let's put it all together in one simple playbook, a cheat sheet you can use to figure out pretty much any withdrawal scenario.
This table right here is your go-to guide. Contributions, they're always yours, no strings attached. Converted principal, you've got to watch that 5-year clock before 59.5, but after that, you're golden. And the earnings, that's the big prize. You need to be over 59.5 and have satisfied that first forever rule to get every penny tax-free.
So there you go. The 2 5-year rules hopefully aren't so scary anymore. When you understand how they work, you can really start to use your Roth IRA as the powerful tool it was designed to be. You have the instruction manual now. So the real question is, how are you going to plan your path to that tax-free wealth?